Hi everyone, and welcome to Barton Associates Locum Tax webinar. We're excited to have you join us today and hope the information provided is helpful as you file your taxes this year. As a reminder, this webinar is being recorded and we'll be sharing the recording with you in coming days. In a moment, you'll be hearing from Andrew Schwartz, CPA, who is the founder and managing partner of Schwartz Schwartz PC in Woburn, Massachusetts. Andrew has provided tax, practice management, payroll, and basic financial planning services to healthcare professionals and their practices since 1993. He is frequently interviewed as a tax advisor on current topics in national media such as abcnews.com, Washington Post, and the Wall Street Journal. At the end of the presentation, we will have time for a question and answer session. If you have questions during the presentation, please feel free to ask them in the chat section located at the bottom of your screen. We've also received some questions prior to today's event. We will answer as many questions as possible. If we don't get to your question, please feel free to reach out to us at info@bartonassociates.com. With that, it's my pleasure to introduce Andrew Schwartz, CPA.
Thank you, Greg. So Andrew Schwartz here. Thank you for taking time out of your busy schedule to attend this webinar today. Again, my name is Andrew Schwartz. I'm partners with my brother Rick Schwartz in the CPA firm of Schwartz Schwartz, based just north of Boston in Woburn, Massachusetts. We have a very narrowly focused niche practice serving healthcare professionals and their practices. Each winter, we prepare more than 2,000 personal tax returns, and more than 90% of those are for physicians, dentists, and psychologists. The rest of the year, we work with about 251 and two-owner medical and dental practices. So we're very familiar with the issues affecting you and your colleagues, so let's get into it right now. Okay, so what we're going to cover today is, for starters, we're going to talk about the basic considerations for independent contractors. We'll discuss common deductions. We will talk about retirement accounts. We will talk about these great things called health savings accounts. We'll talk about how you should pay your taxes by paying quarterly taxes. We'll go over some planning tips, and we will cover the new QBI rules, the qualified business income rules that took effect in 2018. So it's a lot of the information that is pertinent to you and your colleagues, for people who work in the Locum Tenens arena, and hopefully you'll find this informative and interesting. If I could see you face to face, I would ask if anybody took a accounting class in college, and every once in a while somebody did, and I hope you find accounting interesting too. Okay, so let's get right at it. Okay, so let's start by talking about deductions. Okay, so the rule is very simple. For you to claim a business deduction, for you to claim a deduction against your locum's income, the expense that you incur must be both ordinary and necessary in connection with your profession. So if you buy an iPad or some type of device like that you're going to use in connection with practicing medicine or whatever you're doing at work, I would say that buying a device like that would be tax deductible. Now, if you go out and you purchase a Gucci carrying case for that device, you might think that's ordinary and necessary, but I would think that the IRS, if you were to get audited, in the unlikely event that you were to get audited, would disagree. So we're going to talk about a whole bunch of different things that you can deduct, different expenses that you can deduct against your income, and we're going to focus on health insurance, travel, lodging, and meals, automobile expenses, and education, licenses, and examinations. Now, if you follow the new rules that were instituted at the end of 2017, one of the big deductions that actually was taken away from a lot of taxpayers was the employee business expense deduction. So prior to 2018, if you worked as a W-2 employee and you had a lot of unreimbursed professional expenses or unreimbursed business expenses, you could claim those as a miscellaneous itemized deduction on your tax return. The new rules made it so a W-2 employee can no longer claim a deduction for the unreimbursed employee business expenses. However, that does not apply to people who are paid as 1099 contractors. In the locums situation, you guys are paid as 1099 contractors, so you're still able to claim all these unreimbursed business expenses, these unreimbursed professional expenses that you may incur. you're still allowed to deduct all those expenses directly against your 1099 income, even though if you were paid as a W-2 employee, you would no longer be able to claim that deduction starting in 2018. So I want to be clear that all the stuff that we're going over now is all going to be fully deductible to you. So let's start out by talking about health insurance. Now, actually, health insurance, you wouldn't deduct directly against your income. Your health insurance premiums, you would deduct somewhere else on your tax return, but the rules are very simple. If you're not covered under an employer-sponsored health insurance plan, and if you're married and you're not covered under your spouse's employer-sponsored health insurance plan, then all the premiums that you pay are fully deductible on your personal tax return. So it's a great opportunity because it's important to have health insurance, obviously. And so if you're self-employed, if you earn 1099 income, or if you set up a corporation, which for your locum tenens, which we'll talk about a little bit later, whether or not that's a good idea to do. If you are self-employed, you have self-employment income, and you pay your own health insurance premiums or health insurance premiums for you and your family, 100% of those premiums are deductible as an adjustment to income. Now, I want to point out something else. If you're 65 years old or older, and you're paying for Medicare, or you're collecting Social Security and you're paying for Medicare through your Social Security benefit, if you're self-employed, that counts. Those Medicare premiums count as self-employed health insurance. So don't forget when you do your taxes, if you have self-employment income, to also include the Medicare premiums in the amount of health insurance that you're going to claim as an adjustment to income on your personal tax return. All right, so that's pretty self-explanatory. Next up, we're going to talk about travel, lodging, and meals. Now, one of the benefits of being involved in a locum tenens type situation is you get to travel, right? Locum tenens. I hope I didn't mispronounce it too many times. So when you're involved with the locum tenens situation, you get to travel a lot for work and for the job assignments. And if you're not reimbursed for the travel, you get to deduct the travel expenses directly against that income. So let's talk about that for a second. So if you go and you have a home, which is your main place of where you live, and that's where you register to vote, you get your mail, your family still lives there. All these things anchor you to that home, and that is actually your tax home in quotation fingers. If you have a tax home, then all these places that you go and you work for a year or less, as long as you intend to return back to your house, are treated as one long business trip. So that means you get to deduct any unreimbursed travel back and forth between your home and where you're working, any unreimbursed lodging, and you can also claim a deduction for the meals that you incur on this lengthy business trip. And there's two ways that you can deduct your business meals. And how you deduct them has to be consistent for the whole trip. So one way is you base your deduction for the meals on actual expenses incurred, and you have to keep all the receipts or somehow keep track of all the money that you spend on your meals. The other way is you base the deduction on the per diem rate. And in this situation, the IRS actually made things much easier for us. So they came up with a daily rate that you can deduct by metropolitan area, and there's dozens and dozens. So let me see if this is going to cause too much problem. Can I click on this thing? No. Can I click on that thing? 1 second. Let's see if I can't do this. I don't know. All right. So if you go to gsa.gov, on there, you can click to a link on the top of the page that will take you to a place where you can just type in the state where you want to find out what the daily rate is. Boston, for instance, the daily rate is $71 per day. Nantucket is actually $76 a day. New York City, I think I saw that was $76 a day. So if you're on a locums assignment and you're being reimbursed for your travel, you're being reimbursed for your lodging, but you're not being reimbursed for your food, you still get to deduct the daily rate for the food based on either actual expenses or the per diem rate, when you get the total, it's only half deductible. Meals are only half deductible, no matter which way you come up with your deduction, and you claim that total directly against your 1099 income. So it's a great opportunity for my clients. I just have them tell me how many days they were in which city, and that's the deduction that they claim. Now, to be able to deduct the meals and the lodging and any of these things, the Locum Tenens assignment has to be outside of the general vicinity of where you live. So it has to be far enough away that you need to rest after you work before you come home. It would be impossible to commute back and forth and also work a full day without resting before coming home. So that's kind of the rule of thumb with that. And if you do reach that threshold, then you get to deduct any unreimbursed travel, lodging, and meals, and actually also miles for the car, which we're going to talk about in a second. Okay, so let's talk about automobile expenses. All right, so for you to be able to deduct any of the costs associated with your car, you have to drive the car either between job sites, between your home and a temporary job site, and a temporary job site is a location where you work for less than a year, or you need to travel to conferences, interviews, things of that nature. Driving between your home and a regular place of business, a place of business where you work for more than a year, that's generally non-deductible commuting. Okay, so most of these locum situations, I would guess they last for less than a year. So so the mileage would be deductible just based on the locums being a temporary job assignment, lasting less than a year. And to claim the automobile expenses, you basically have two options. One is you can base the deduction on the standard mileage rates. And for 2019, that meant that you could deduct 59 cents for every business mile driven, 58 cents, sorry. And for 2020, they reduced the standard mileage rate by a half a cent, so it's 57.5 cents per mile in 2020. You just figure how many business miles you drove during the year, and you multiply that by the standard mileage rate of either 58 cents or 57.5 cents per mile, and you come up with the deduction, and you would claim that deduction directly against your 1099 income. The other option is to base the deduction for your car on actual expenses incurred. So what that means is you tally up the amount that you spent on gas, insurance, repairs, parking at home, and lease payments if you lease a car, or a factor for depreciation if you own the car. And then you have to figure out how many total miles you drove during the year and how many of those miles were business miles, and you come up with a percentage of business miles divided by total miles, and you multiply the actual expenses incurred times that percentage, that ratio, and you come up with your automobile expense based on that. Now, over the years, what I've seen when it comes to automobile expenses is that people over time tend to be better off claiming the standard mileage rate unless they drive very few miles during the year, and most of those miles are business miles. Right, so if you drive 20,000 miles during the year and they're going to give you 58 cents a mile, that's a what is that? That's a $11,600 deduction. You probably don't even spend that much on your automobile expenses during the year. And then if you drive a lot of miles, you probably the fraction won't be that high because the business miles are only going to be so many. But let's say you live in a city and you're working in another city, and the only driving you do, more or less, is from your home in the city to the place you're working in at locums, and you don't drive a heck of a lot of miles. Well, in that situation, you'd probably be better off taking a high percentage of the actual expenses incurred. So you can work through the numbers, but as I said, if you drive a lot of miles, over time, it just tends that people do better just claiming the standard mileage deduction, plus it's actually one less group of expenses that you need to keep track of. But it doesn't take that long to go through the math and figure out which way is better. Okie dokie. All right, this next group of expenses, it's kind of interesting, the theory behind it. So basically, anytime you do something that qualifies you for a new trade or business, so medical school, undergraduate college, dental school, any of those things, anytime you do something that qualifies you for a new trade or business, those expenses are not tax deductible. Anytime you do something that enhances your skills in your current trade or business, that is all tax deductible. And so if you become a physician, your initial license is not tax deductible, but anytime you need to get a license renewal, that is tax deductible. And once you have a license, if you have to get licensed in other states, all those costs would be deductible as well. And I'm looking at the screen. Okay, so let's think of some other examples. So your license renewals are deductible. Your all the different state licenses are deductible. If you take classes that enhance your skills in your current profession, those are deductible. So maybe you travel to a place where English isn't the first language that people speak, and you want to study that language, and you go to a college and you pay for tuition and you study a different language so you can enhance your skills in your current trade or business. I would say that would be tax deductible. I know physicians, sometimes they do an MPH, they maybe get the healthcare MBA, they do things like that. All those expenses would be deductible against your 1099 income because they are enhancing your skills in your current trade or business, and they are not, it doesn't qualify you for a new trade or business. All right, so that's a pretty short one. All right, here we go. So now let's figure out how we can use the tax rules to really help you, one, minimize your tax bill, and two, start to build up a nest egg for, to fund your retirement and just to make you feel more comfortable with the amount of money that you have. So the first and best way to do that is by setting up a self-employed retirement account. Okay, so for starters, I want to point out that for pretty much anybody in their working years, contributing to a retirement plan is one of or is the best tax shelter available to you during those years. Okay, because when you put money into a retirement plan, unless you go with the Roth version, which we're not going to get into with this thing, but with this webinar, but when you put money into a retirement plan, it saves you taxes in the current year. The money in the plan grows tax deferred, and then when you take out money later, you pay taxes on the money that you take out. But saving taxes today and tax deferred growth is what makes it the best tax shelter. So I want to give you an example of just how great it is, these retirement plans. So I'm going to suggest to you that when you put money into a retirement plan, when you put deductible money into a retirement plan, you're going to get an immediate 44% return on your money. 44%, do you believe it? Okay, how do you do that? So let's say that you're in the 28% federal tax rate. I actually don't even know if there's a 28% rate anymore. But 28% federal tax rate and a 5% state tax rate. So your combined marginal tax rate for those two taxes is 33%. If you're in that tax bracket and you put in $1,000 into your retirement plan, your self-employed retirement plan, you'll save $330 on your tax return. It'll only cost you $670 of after-tax dollars to have $1,000 growing tax deferred in your retirement plan. So on your $670 investment, you already earned $330, right? Right? Does that make sense? So you put in $1,000, the government gave you back $330, so it only cost you $670, and you have $1,000 growing in your bank account, in your whatever mutual funds or wherever you decide to keep the money. You earn $330 right off the bat on your $670 investment, and you have $1,000 in the account. 44% return on your money. Yes, you do need to pay back those taxes when you start drawing the money later. But the benefit of these plans is quite simple. The benefit of these plans is you get to invest the $330 that the government gave you back. You invest the $330 and you keep the compounded earnings on the government's money until you draw the money out decades down the road. Okay? You put in $670, the government puts in $330, you invest $1,000, you keep the compounded investment earnings on the $330 for every $1,000 you invest. There's nothing else like it, and it really accelerates how quickly your retirement plan, your retirement nest egg grows just because you get to keep the compounded earnings on the government's money all these years, plus you don't owe any taxes over the years as the investment portfolio, turns over and things of that nature. I want to point out one more thing with these retirement accounts. So not only are they tax advantaged, but these retirement accounts, for the most part, are also creditor protected. Okay, so if you get sued or unfortunately have to go through bankruptcy or something terrible happens like that, the money in your retirement account should be protected from all of your creditors. The common type retirement plans for people who are self-employed are the following. Popular options include SEP IRAs, simple IRAs, and solo 401k plans. So with a SEP IRA, you can put away 20% of your net self-employment income. So the amount on your 1099, less the expenses you incur, that's your net self-employment income. So a SEP IRA, you can put away 20% of your net self-employment income. So let's say you make $100,000, you have $20,000 of expenses, that leaves $80,000 of net self-employment earnings. You'd be able to put away $16,000 into a SEP. A simple IRA for 2020, you can put away $13,500. If you're 50 or older, you can put away $16,500 plus 3% of your self-employment income. And with a solo 401k, you can put away a lot of money. So for 2020, a solo 401k, you can put away $19,500 if you're under the age of 50, or $26,000 if you're over the age, if you're 50 or older by the end of the year, plus 20% of your net self-employment earnings. So it's basically a SEP plus either $19,500 or $26,000. We have clients, and one spouse will make a lot of money, and the other spouse is self-employed and makes like $50,000, $60,000 perhaps, and they set up a solo 401k. They end up putting $40,000 or something like that away into their. That can't be that much. Say they're over 50, it'll be $26,000 plus 12. Yeah, it'll be $38,000 on $60,000 into a pre-tax creditor protected retirement account if they set up a solo 401k. There are some other limits with solo 401ks if you do work somewhere else where you have a 401k there. But if the locum situation is your only situation, you can put away a ton of money into a solo 401k. And people who need to catch up for their retirement savings, and maybe their kids are grown and they have some extra money, there are these plans called defined benefit plans. And with a defined benefit plan, you can actually put away like $150,000 based on what you earn each year into one of these plans, and it really helps healthcare professionals who weren't able to put away as much as they should have put away over the years catch up with their retirement savings before they retire. So, and having a locum situation and setting up a defined benefit plan and having the money to do it is a great way to just sock away a ton of money in the last 5 or 6, 7 years that you're working before you retire. Okay, so retirement plans are great. People, if you're self-employed, it's just such a good opportunity to save taxes and to build up some wealth. Definitely, please try not to overlook that. And then we're going to talk about these other accounts called health savings accounts. So basically, when you're trying to save money, one way you save them is in these pre-tax accounts. So pre-tax accounts is your 401k if you work for somebody. It's IRAs if you don't have availability to any other retirement plans. You can put money pre-tax into an IRA. And if you're self-employed, you can set up a self-employed retirement account that we just went over kind of quickly. Then there's also these tax-free accounts. So tax-free accounts is where you put away post-tax dollars. So you don't get a deduction when the money gets put away, but that money grows tax-free. And that's a Roth IRA. So a Roth IRA, post-tax money grows tax-free. It's a 529 account for your kids' college education or your grandkids or somebody else. You put away post-tax dollars. When you turn in those accounts to pay for college down the road, you don't owe any taxes on the earnings. And actually, I have a lot of clients who are about my age. I'm mid-50s, and their kids are in college, and they're turning in their 529 accounts to pay for college. And there's a lot of income built in those accounts that is coming out tax-free. 529 accounts are great way to save for somebody's college education. And a third post-tax type situation that grows tax-free is actually your home ownership. If you sell a home that you lived in for 2 out of the last 5 years that you lived in and that you owned, and you're married, the first $500,000 of gain isn't taxed. And if you're single, it's the first $250,000. I am trying to make a point here. And the point is, we talked about pre-tax opportunities. We talked about tax-free opportunities. But there's only one opportunity I know of that is a pre-tax contribution that grows tax-free, and that is a health savings account. So a health savings account is a very specific type investment opportunity where you need to have a qualifying high deductible health insurance plan. So you need to be a participant in a certain type of high deductible health insurance plan. Whoever you get your health insurance from will let you know whether your plan qualifies as a qualified high deductible health insurance plan. And if you do have that plan, you're allowed to set up a companion account called a health savings account. So if you ever worked anywhere and they let you set up what's called a flexible spending account, the flexible spending account was a employer-controlled account that had this use it or lose it component where if you didn't spend the money by the end of the year, then you forfeited the money more or less. So there were some exceptions. With a health savings account, you don't need to spend the money. That's your account. It's just like an IRA or like a 401k. It's your account growing tax deferred. So let's talk about these. Let's continue to talk about them. So with a health savings account for 2019, you can put away $7,000 into the HSA for if you have a family type plan, and $3,500 if you just have an individual plan. And next year it's increasing by $100 if you're married or have a family plan, or $50 if you have a single plan. So if you have a qualifying high deductible health insurance plan, for 2019, you have until April 15th to put the money away. You can put away $7,000 or $3,500 as a pre-tax contribution. That means you'll report that on your tax return and you'll save taxes. The money that's in the HSA grows tax deferred. Any money that comes out of the HSA to pay for you or your family's medical expenses, anybody who's a dependent, that money comes out tax-free, and any money still in the account when you turn 65 can be taken out to supplement your retirement. That money is not subject to the early withdrawal penalty, but you do owe income taxes on that money. But everybody's going to have medical expenses, especially the older you get, that you can use the HSA money for. A lot of people, they have the strategy where they fund the HSA to the extent that they can fund it each year. They get the tax deduction, and they're just letting the money grow in the HSA tax deferred. They're not taking it out to pay for their family's medical expenses. They're paying for the medical expenses just out of whatever money's in their household checking account, and they're going to take advantage of this one other place where money is growing tax deferred. But if you're in a position where you can take on a little bit more risk with your health insurance, and you want your health insurance to protect you against a catastrophic, but not to pay all your bills, and you're still going to go to the doctor and do all your preventative checkups and all that stuff, then search for a good qualifying health insurance plan that allows you to set up an HSA, and then just fund the HSA to the extent that you can every year. And I have clients, these things, they're not that new anymore, but they're still pretty new. But I have some clients who now have more than $100,000 or so in an HSA, and that account's going to keep growing. And more of the financial institutions are allowing people to invest in an HSA. So I'm sure you'll be able to find one. And invest in Vanguard funds or Fidelity funds or something like that. Schwab must have them. They're all going to have them. Because the money a lot of people is just going to sit there. Okay. So you work as your locums, right? And you have to pay taxes, right? So unfortunately, if you don't set up an entity, and we're going to talk pretty soon why I don't think that's always the best idea anyways, especially under the new rules. If you just work as a 1099 contractor, then the more you make, the more you're going to owe in taxes, and the government wants you to pay those taxes throughout the year, and you do that by paying quarterly estimates. And the quarterly due dates aren't what you think they would be. The quarterly due dates are April 15th, June 15th, so that's only a 2-month quarter, September 15th, and then January 15th of the following year. All the The tax software is all set up your quarterly estimates for you. They're pretty easy to submit. You can do it online at irs.gov, or you can send in a paper voucher with a check if you prefer doing things that way. So most people figure out they look at what they owed in taxes the year before, and they'll use that to calculate their estimates, or they'll do a little bit more sophisticated calculation and try to figure out how much you're going to earn in the current year, and then pay that in each quarter. If you don't pay in enough taxes, the first year you owe a lot of taxes, the government usually gives you a buy, subject to certain other rules, so there's ways to for them to waive the penalty. After that, though, if you earn a decent amount of money as a 1099 contractor and you owe a lot of money 2 years in a row, the second year they will charge you a penalty, and the penalty is about 2 or 3% of the shortfall. So if you're $20,000 short on your taxes, your penalty would be like maybe $500 or something like that. So it's not too terrible, but to send in a check once a quarter to save $500, that's a dinner at a really nice restaurant. Actually, probably more than one dinner. So yeah, if you think of things in terms of that, it's probably worth doing. Now, if you work at various states, things get a little bit complicated. So here's the rules. It's actually not that complicated. So first off, you pay taxes in the state where you work, okay? So if you work in a state that has an income tax, unless some states have reciprocity, but for the most part, you first have to pay income taxes in that state. Then you need to calculate the income taxes on the state where you live, and you reduce the taxes you pay in the state where you live by the taxes you pay to the state where you work, up to the same thing. So basically, if you live in a high tax state and you work as a locum situation in a state that has a lower tax rate, you will pay the full tax of the state where you work, and you would pay the difference to the state where you live, right? If you work in a state that has a higher taxes to the state that you live, you would basically pay the taxes to the state where you work, and you won't pay any taxes on that income to the state where you live. If you work in a state that has no income taxes, then you only pay taxes to the states where you work that have an income tax. If you live in a state that has income tax and work in a state that doesn't have income tax, you only pay taxes to the state where you live. So basically, you end up paying taxes on that income to the state where either you work or where you live that is the higher rate. And how it's divvied up depends on whatever, all that stuff I just went over. So, but if you go and you work in a state where you haven't worked before, they want you to pay estimated taxes right off the bat. They won't give you the opportunity to waive the penalty if the first year you work in the state where you hadn't worked before. So when you go to a new state, you probably want to figure out what the rate is and kind of start sending in quarterly estimates the quarter right away, the due date following the date that you start. Okay. Okay, so here's some planning tips that we like to help our clients with. So over the years, so I said we do a couple thousand of these tax returns per year. We don't have that many clients who've gotten into trouble with their taxes. The ones that did get into trouble and fell behind are people who are self-employed and don't plan ahead. So I think I want to help you plan ahead. So first is we are a firm believer of this thing called the 40% rule. So basically, when you get paid as a 1099 contractor, pay your expenses that you can deduct against that income, then take 40% of the excess and put it into a savings account and use that to pay your taxes. As money grows in that account, you need to remember that that money is going to go, ultimately, most likely, most of it, to pay your taxes, okay? 60% of what's left over you can take and you can spend, 40% you go to the government. I want to point out when you work as a 1099 contractor, you're going to owe federal taxes on your net self-employment income, and you're going to owe state taxes based on that whole thing I just went over with you. But you're also going to owe this thing called self-employment taxes, which are Social Security and Medicare taxes for people who are self-employed. So when you work for somebody, your employer withholds Social Security and Medicare taxes at 7.65%, and then the employer matches those taxes. So you end up getting, so the government gets 15.3 cents for every dollar that you earn. When you're self-employed, in addition to paying the federal and state taxes on what you owe that 15.3% tax on the first, I think it's $135,000 or so that you earn this year. Then it actually goes down. So that's why the tax rate goes over 40% in a hurry, because you're going to pay federal taxes at your marginal rate, state taxes or whatever the rate is, plus this 15.3% tax. We talked about paying quarterly estimates. That's the best way to just keep current with your taxes. You definitely want to track your professional expenses. When you're self-employed, besides putting money into a retirement plan, which is a great way to save taxes, and maybe setting up an HSA, which is a great way to pay taxes. Another way for you to save taxes is to make sure that you deduct all the allowable professional expenses against your 1099 income. And we went over some of the expenses now. There's a link here to a handy spreadsheet that you can get from my firm's website. It actually might even be on Barton's website. You can just easily track your expenses. There's other ways to track your expenses. The first and best way is to use one of those personal finance programs such as Mint.com. Mint.com is a free program. It's owned by Intuit, and it just downloads all your transactions. You got to classify them at first, but it learns how to classify the transactions. Then at the end of the year, you can print a nice report that shows all your professional expenses that you want to deduct against your 1099 income. A second option is to use a separate bank account and or a separate credit card only for your business-related purchases. And then at the end of the year, you just compile what went on in those accounts. So that makes it easy. Third is just a spreadsheet that you can download and you can use to keep track of your expenses. And the fourth and least good way is to set up a separate file and just keep your receipts in the file, and at the end of the year, just tally them all up. But you definitely want to track your professional expenses, and you want to keep good records. We talked about the tax shelters, which are the retirement accounts and HSAs. And even though this stuff seems like it's pretty easy, the rules are always changing, and tax professionals do know some of the ways to help self-employed individuals save taxes. So somebody who's a real student of things around them, they can teach themselves these things, and they can minimize their tax bill. But a lot of people find it's worthwhile to work with a tax professional or a CPA, especially one who works a lot with your colleagues and stuff and sees what everybody else is doing and hears the questions that everybody else is asking. Okay, I want to talk about the QBI deduction. 2019 is the second year for the QBI deduction. QBI is the Qualified Business Income Deduction. So basically, if you have self-employment income, or if you are a partner in a partnership or a shareholder of an S corporation that has income flowing through to your tax return, you can get this extra deduction that is equal to 20% of the taxable income that you're reporting from your entity there. So it's a great deduction. It's brand new. If you're married, the threshold isn't even that low. If you're single, it's maybe a little bit low. So if you're married, the threshold, the phase out for the QBI deduction is between $321,400 this year and $421,400, and that's basically taxable income before the QBI deduction. So that's your income after deductions. So if your income is if your income is below $321,400 if you're married, or $167,000 if you are single, then you will get a deduction equal to 20% of your net self-employment income, adjusted by a few things there. If you're over $421,400 or over, $210,700, and you're in a field of medicine, then you don't get any QBI deduction. And if you're between the two, then there is some element of a phase out that you have to calculate. The software would do it for you. But it's a great way to save some taxes, and that brings up the point of whether or not it makes sense to incorporate. So let's talk about that for a few minutes. Does it make sense for you to set up a corporation for your locums? And unless you're going to make a ton of money, I'm not sure that it does. So for starters, if you set up a corporation and you're going to do it right, for you to work in the different states, you need to register the corporation in all the different states. That just seems like a nightmare. And that applies to LLCs too. But secondly, when you set up a corporation, and you don't have any other employees already, you're going to pay a whole bunch of fees and taxes. So if you set up a corporation, you all of a sudden have to do a corporate tax return. So you have to pay someone to do the corporate tax return, most likely. Most states have some element of a minimum tax. When you have a corporation, you need to put yourself on payroll and pay yourself a reasonable salary. So you have to pay someone to do the payroll unless you want to do it yourself. And then if you're going to use an app or something, you have to pay that. There's new payroll taxes that you don't owe as an independent contractor, and that includes unemployment taxes. There's mainly unemployment taxes. You can opt out of workers' comp, I know, in Massachusetts. So there's all these extra fees and everything. And if you're going to pay a payroll fee, a corporate tax fee, and a minimum tax, you're looking at like $3,000 or $4,000 right off the bat between all this extra stuff. And if your income isn't over like $350,000, you're not going to get enough benefit by being able to pay yourself a certain way and take out money to avoid paying the Medicare tax. It's very tough to recoup the costs and the headaches of having a corporation, unless, in my book, your net income is going to be $350,000 or higher. So the other thing that affects whether or not it makes sense to incorporate is if you incorporate, you need to pay yourself a reasonable salary, which reduces the income that's going to flow through to you from the S corporation. So if you're in a situation where you're going to get the maximum QBI deduction, your QBI deduction will be smaller because the amount of money you take as your W-2 salary from your corporation doesn't qualify for the QBI deduction, just the net income. If you're self-employed, all the income qualifies for the QBI deduction. So with the new rules, depending on your income and things like that, I'm not a huge fan of somebody going out and becoming a corporation. I do hear from time to time about people wanting to get limited liability. You do want to discuss this with a lawyer. I'm not a lawyer. I'm an accountant. I understand the taxes, but generally, if you get adequate insurance and you get an umbrella policy and things of that nature, and you get the right amount of malpractice insurance, you can insure away most of the risk. And if you are providing professional service, the corporation doesn't protect you from mistakes you make at work. That's malpractice insurance. They couldn't do that because if not, everybody would set up a corporation and then be off the hook if something terrible happened. So it wouldn't be feasible to do something like that. All right, but that's the QBI deduction in a nutshell. Okay, so great. So they told me to get through this in 45 minutes, and I think I did that. So let's see, Greg, do you want me to answer some questions?
Yes, so we have a lot of really good questions. Just to clarify for everybody on the webinar, we will be emailing the presentation. It's being recorded, so we'll be emailing this out. We'll also be emailing you the actual presentation, so you'll be able to click on those links and get those really helpful resources as well. And then we also have Barton Associates has a Locum Tenens tax guide that we will also be emailing out, which has been worked on by Andrew as well. We're going to try to get through as many questions as possible. We have 30, 40 questions. If we don't answer your question, don't worry. We have it recorded, and we will work with Andrew to try to answer those as timely as possible. So with that, Andrew, there's a question right here. So, can I deduct my husband's Medicare and supplemental insurance? He's retired and I'm working as a 1099.
So I go with the, when I do someone's tax return, I actually do take the spouse's Medicare, but I don't take the supplemental insurance. And that's my understanding of the rules. The rules, they're so complicated, and there's unfortunately nowhere to find these answers a lot of times. But I'm comfortable taking the Medicare. I've read the rule, and that they are allowed to do that. If the spouse isn't an employee of the business, I don't think that they can. But that's my understanding of the rules.
Okay. What about are people able to deduct Medicare Part B costs and copays?
Not copays, but Medicare Part B. Yeah, I take all the Medicare and the.
Okay.
I take the drug too. Yes.
Okay.
Yep.
Are there any deductions for taking a spouse's health insurance?
You can take a family plan if you have a family plan, but I don't think you can just take the spouse's. So it's kind of, kind of random, but again, that's my understanding of the rules, and when I do someone's taxes, that's how I do it. If someone has a family plan, I'll take the full premium. If one spouse is on Medicare, I will take that on the self-employed person's form. But if there's two spouses and one has an individual plan who isn't the self-employed person, I wouldn't take it. Just repeat myself, that's my understanding of the rules. But someone could read the rules and get something totally different out of it.
Okay, great. Can you deduct the cost of COBRA if you are transitioning from W-2 to 1099 employment?
I actually do deduct that, yes.
Okay,
and,
great.
And I think it's a gray area, and I've been doing this for 32 years. This winter's going to be my 33rd tax season. Don't be jealous. I've never seen that question. So the COBRA we do take, because usually that's the best way to get the best policy for the lowest price. So there's a business decision to go with COBRA.
Okay. Are costs of unreimbursed trips back home during the assignment, say on a weekend, reimbursable?
I would say yes. So it's this whole thing with establishing your home as a tax home. So if that's a place where you live, where you vote, where you get your mail, where your family still lives, and you're going to go back when the assignment is over. You're not a transient employee worker who's going to go from place to place to place. That's your home base. Then if that's your home base, that's your tax home, and commuting between your tax home and a place of business outside the general vicinity where you live is deductible, even if you go back for weekends while you're working during the assignment, yes. So I would say without a doubt.
Okay. Groceries, are those kind of fall under the meal deduction? Yes,
I would say it's either the daily per diem rate or groceries, yes, because you have to feed yourself, and both are half deductible.
What about Uber expenses? Are those deductible?
Yeah, I would say you're on a business trip, so all the expenses incurred while you're on a business trip are deductible.
Okay. And I think you covered this, but when you do work in another state, so for example, we're in Massachusetts, if we were to do a Locum Tenens assignment in Florida, or not Florida, they don't have income tax, but in New York, would we have to pay the taxes in that state as well as Massachusetts?
Okay, so the New York state rate's like 6-point-something%, and the Mass rate's 5%. So you would go there and you would pay the New York tax at 6%, and since the New York rate is higher than the Mass rate, the Mass tax on that income would be completely offset by the New York credit. So you would only end up paying taxes to New York. You end up paying taxes at the higher rate, whether it's the state where you work or the state where you live. If your home state rate is higher than the state where you work, you pay the difference on the home state. You know what I mean?
Yep. A follow-up question on the grocery question. If you are working locally as a 1099, can you deduct grocery costs?
No. So if you're within the general vicinity of where you live, you're not supposed to deduct your food.
Okay.
Because you have to eat anyway. Yeah.
So if somebody doesn't have an HSA set up yet and they set one up now, that would probably only affect the 2020 taxes, not 2019?
No, they have until April 15th to set up an HSA for 2019 if they had a qualifying high deductible health insurance plan in place during 2019. And they're actually pretty liberal about it, where I think you only needed to have the plan set up like near the end of the year, and you can still put away the full $7,000. But there's some catch that you have to keep the plan open all 2020, or you have to pay back some taxes or something. But yes, the due date is April 15th to 2020 to fund an HSA for 2019, even if you go on extension. That April 15th deadline holds true.
Okay. Question about some education deductions. So this person finished their master's in December for their current job enhancement. There's a section that asks you about full-time education expenses versus using it as a write-off. Where does that get placed exactly then?
Wait, you mean, do you ask about the credits or something, the education credits?
Yeah, so I'm just reading the question here. It said, I finished my master's in December for my current job enhancement. There is a section that asks, I'm assuming that when they're doing their taxes, about full-time education expenses versus using it as a write-off.
So what I've done is I'll take expenses to the full amount that people get the education credit, and I would take the remaining expenses directly against your 1099 income. So you can't double dip. So the lifetime learning credit, you get a credit of 20% of the first $10,000 you spent. So I would take the first $10,000 to calculate the lifetime learning credit, and then I would take the amount of money they spent over and above the $10,000 as a deduction against your 1099.
Okay. So what if so some locum situations are actual W-2 employees. What are some of the deductions that they can take when they're not a 1099 employee?
Under the new rules, nothing. You can't do moving expenses. You can't do these unreimbursed employee business expenses. You can do the HSA, and then even the retirement, you're bound by whatever that organization offers their staff for a retirement plan. So a lot less flexibility. Yeah, not as good.
Yep. So there are some locums out there who have a permanent job and do locums on the side. Can you clarify on the taxes and deductible expenses for those who are both a W-2 employee and the 1099 employee?
So we're pretty aggressive here. If someone has W-2 income and 1099 income, we generally take most of the unreimbursed professional expenses against the 1099 income. We won't show a loss. So if someone earned $10,000 and has $20,000 of expenses, we won't show a $10,000 loss, but we'll write off the $10,000 of income pretty close to zero. So this is a place where you can be a little bit aggressive, and as long as you incur the expenses and they're reasonably legitimate expenses, I would take them against the 1099 first, especially since you can't take them against the W-2 income anymore.
Okay, good to know. What are the options for SEP or IRA if you're over 72? Okay,
so if you're over 72, you cannot contribute to a traditional IRA, but you can contribute to a SEP as long as you're working and you have self-employment income. That age limitation does not apply to SEP IRAs and simple IRAs and things like that. Now, if you add money to a SEP IRA and you're over the age of 72, it will increase your required minimum distribution the next year, but it's still worth doing. So it's not the same rule as with a traditional IRA where you have to stop the year you turn such and such an age. And they might have gotten rid of that because they just passed a bunch of changes to the retirement plans, and I thought that might be one of the changes that they made.
Okay. This person asks, can I deduct 58 cents per mile if the locums company that they're working for is paying them 58 cents a mile for travel?
No. The only way you would do it is if they throw that 58 cents per mile on the 1099, then you would have to deduct the 58 cents per mile so you don't pay taxes on the reimbursement. But if they don't put that as income, no, you can't do that.
Okay. If you just completed school and became licensed, your income will increase substantially from the previous year. How should you estimate your quarterly taxes?
So if your income is increasing, the easiest thing to do actually is to base your estimated taxes on the prior year's tax liability. So that's the minimum that you need to pay in to avoid being penalized. If your income's below $150,000, you just need to pay in 100% of your prior year's tax. If it's over $150,000, you need to do 110% of your prior year's tax. But if you pay in that much money, then you won't be penalized for underpaying your taxes no matter how much you owe. So we have people who do this 40% thing. They open a separate savings account where they put away 40% of their money. They pay the minimum amount of estimates. They write a big check in April, and they get to earn some interest on the money. So while someone's income is increasing, it's just as easy to base the estimates on the prior year's tax and set aside money to pay the remaining taxes on April 15th and earn a little bit of interest while you're at it.
All right. Here. And there's a lot of really great questions, everyone. We're doing our best to get those questions answered. We will work as fast as possible to get ones that we don't answer today answered in a timely manner. This person asks, I work from home via computer. What tax deductions for home office can they take?
So if someone's paid as a 1099 contractor, the home office deduction is a great thing to do. There's two ways to do it now. One way is you base your deduction on they basically let you take $5 for the first 300 square feet that you use as the home office, so it's a $1,500 deduction. You don't need to get involved with doing the form, with keeping track of your utilities and your repairs and maintenance and depreciating your house and all this stuff, but you don't get quite as big of a deduction. If you rent versus owning, if you rent where you live, claiming the home office deduction is great because you can you write off a portion of your rent against your income. If you own a home, you can still claim the home office deduction. We have a lot of people who do that, and you just, based on square footage, you deduct that portion of your mortgage interest, your real estate taxes, insurance, utilities, repairs and maintenance, and then you have to depreciate the house over 39 years. But you end up, people save money. It's a great way to save a little bit of taxes. Any depreciation you claim, you do need to recapture as income when you sell the house, but it's usually not that huge of an issue. But if you work from your home on a regular and exclusive basis, you use a portion of your home exclusively for business, the home office deduction is a worthwhile thing to do. If you go to irs.gov, it's the Form 8829. It's not that complicated. Oh, and lastly, with the whole new rule with the SALT deduction, the state and local income tax deduction is now capped. That means the real estate taxes you pay probably aren't deductible if you earn a decent living and you live in a place that has decent real estate taxes. So by moving some of the real estate taxes to the home office, it makes some of your real estate tax deductible again. That wouldn't have been otherwise deductible.
All right, great. This person asks if there is a mortgage deduction if you are out of state for over 365 days.
If you own the home? Yeah.
Correct.
So if you continue to own the home, you continue to take the mortgage deduction. If you're out of state working at one place for over 365 days, that kind of becomes your tax home. It's no longer a temporary job assignment. That's where you're living because you're living where you work. But your home would then be the second home, and you can deduct mortgage interest on your primary residence and one second home.
All right. Is there a main benefit of being a C Corp versus an S Corp?
Oh, a C Corp. The C Corps aren't really designed for somebody who is self-employed as far as I'm concerned. Yes, the tax rate for a C Corp is very low now. It's 21%. But to get money out of the C Corp, you either need to take salary or you need to take a dividend distribution. So you end up being taxed at a very high rate. No, I don't think C Corps. Plus, you don't get the QBI deduction. I wouldn't have a client come in who wants to do locums and recommend that they set up a C Corp. The S Corp is good, but as I said, unless you're going to make more than $350, I would be a sole proprietor. That's what my clients are doing now. Or they're setting up single-member LLCs, which give a little bit of legal liability protection, and then it's a disregarded entity for tax purposes, so they're a sole proprietor. However, once you start working in different states, you have to register your LLC. I don't know how hard that is to do.
Okay. So this is actually a really interesting question. I think that'll help a lot of people. This person said, what strategies would you recommend in screening and looking for a good CPA/tax advisor in your local area more than just using Google or Yelp? Are there professional organizations of CPAs or tax advisors that are fiduciary-minded for their clients?
That's a good question. What would I do? Well, the medical community is kind of a pretty tight-knit community. I would just ask around, because people tend to work with the same type professionals with all sorts of things. Like there's the same accountants, there's lawyers who deal with medical, and there's insurance people and financial people. I would ask around and ask colleagues who they like. The reviews are important, but I don't know. People either get 5-star or 1-star reviews. There's really not a lot of people getting in the middle. I don't know what I would ask around, and I would interview 2 or 3. It's like when you're ready to buy a house, you go to open houses, and you don't see that many houses before you get a feel for the market. You go to a couple of accounting firms and you get a feel for whether they're, how they go about their business and how responsive they are and things of that nature.
Great. All right, everyone. I think this is one last question, and like I said, we will work our best to get as many questions answered as possible in the coming days. This person asks, my husband and I will both be working 1099 this year. What is the best way to set up a company?
They're both going to be working at 1099s. They can each do their own Schedule C. It depends on how much they're going to make. If they want to set up a company, they can set up an LLC that's going to be treated as a partnership, but when everything flows through that and comes back out, it's going to be as if they're both self-employed. Depending on the state they're at, and whatever is going on, they need to talk to either a lawyer or their accountant person and figure out what makes the most sense. It's just, every situation's different. I'm not opposed to just people having their own single-member LLCs and not overdoing it. It's just the more complicated somebody makes things, it's tougher to comply. It's administratively, it's more work, it's more cost, and it doesn't get you a heck of a lot, especially under the new rules. So I would just say they can both have their own Schedule C. Great.
Okay. I think, given the fact that, we've hit 3 o'clock, that, we'll go ahead and end for today. Everyone, I just want to, first of all, thank Andrew for a really great presentation. We really hope that there was a lot of information covered, and that we hope that you got a lot of information out of this. We will be sending this recording out in the next 2 to 3 days. We also will be sending our locum tax guide, as well as Andrew's presentation, because I know there's a lot of links out there that will really help. Like I said, we've had 70 or so questions altogether. We will try to kind of put together something to help answer as many questions as possible. On behalf of Barton Associates, I just want to thank you for attending, and we really hope that you found this as useful as we did.
Okay, great. Well, thank you. Thank you for the opportunity. I really appreciate it.